All right, guys, today I want to talk through how to analyze your financial statement packet that you get like a pro. What we're looking at on a monthly basis when we get our reports from our accountant, CPA, bookkeeper, internal bookkeeper, whoever you have working for you. Really want to dive deep into understanding how to analyze these financial statements. So, in a financial package, you should get three reports each month. You should get a profit and loss, P&L. It's probably the one folks are most familiar with and looking at each month. Two, should get a statement of cash flows report. We'll dive into that here in just a second on how to analyze that, what that's telling us. In three, balance sheet, probably a report we're familiar with, but not super confident in how to read or understand. So we're going to start with the P&L, what most folks are familiar with in reading. So profit and loss statement, what that is telling us is our operational activity for the month, for the year, depending on the dates of the report we're looking at, that tell us how the practice is doing operationally from the finance seat. So we're going to see top line revenue. So how much money has come in from production this year? So how much money have we collected from operations of the practice? Under that, we're going to have our expenses broken up into two categories. We're going to have cost of goods sold, which is going to get us down to a gross margin or gross profit. And then under those, we're going to have operating expenses, aka OpEx is what I typically refer to it as, which will get us down to a net operating income. Under that net operating income, we're going to have just a few items, really accountancy type items that we'll get into here in just a second. So the P&L again, revenue coming in, really self-explanatory. Most folks know what that is. Within the cost of goods sold section, how we view it from our perspective, cost of goods sold is the cost of doing clinical care. So up in the cost of goods sold section, what we see, we are typically going to see our clinical employees housed up there, associates, doctor pay. If you're an owner, that's a little bit different, and you're paying yourself. We our chart of accounts are set up a little bit differently. We're going to put that down below the line, but really just thinking through here, cost of clinical care in a vacuum. So again, clinical employees, their pay, associate pay, doctor pay, clinical pay for those clinical employees, dental supplies, lab fees, all of those are going to be incorporated into our cost of goods sold section. Take our revenue minus cost of goods sold, that gets us down to our gross profit. What we typically like to strive for is a 55% gross profit. So 45% cost on those cost of goods sold, 55% gross profit is what we are striving for in a really high achieving dental practice. Under there, we're going to have our operating expenses. So these are going to tend to be more fixed in nature. So non-clinical employees, rent, marketing, office supplies, your legal fees. Think anything that's going to typically be more fixed in nature. Those are all going to be housed in our operating expenses category. So what we like to see is roughly about a 30% operating expense target. So if you recall, we have 45% cost of goods sold, gets us down to that 55% uh, gross margin. Under that, we're going to have those operating expense categories, non-clinical pay, facility expenses, rent, marketing, things like that. Target 30% to get us down to net operating income of a goal of 25%. 25%, really, really healthy practice. That's what we're striving for here. So what that snapshot tells you right there is when we look at net operating income, that's the first metric I look at when I look at a P&L is net operating income. That's going to tell me revenue minus all practice level expenses, what it costs me to run my dental practice. Underneath NOI, we will see some other expenses, which will get us down to net income. Oftentimes down here, we're going to see interest, depreciation, amortization. We drop all that down below the line because those are items we need to see on the P&L, but they aren't technically cash out the door or attributable to operations per se. So we're going to drop that down below the line. We want to see a true operational profit. So our NOI again is going to be revenue minus all practice level operating expenses. Under NOI, we're going to have those interest expense categories, maybe some owner expenses that we need to run on the P&L. Depreciation, amortization, which is going to get us down to a net income. So one big common misconception we see and talking with clients all the time is, okay, Caleb, I have a net income. Let's just say for simple math, I had net income of $100,000 this month, but my bank account did not go up by $100,000. Why? Isn't that how much money I made? Isn't that the profit? No, it's not. So part of the reason of shooting this content today is explaining how we get to actual change in cash and analyzing the financial statement. So we've talked through the profit and loss and key categories, what targets we should be striving for. We're going to go on to the next report, which is the statement of cash flows. So statement of cash flows, again, what the design of the statement of cash flows or the purpose of the statement of cash flows report is to tell us our actual change in cash. So um, P&L gives us a really good indicator of how the practice is doing operationally from a finance perspective. What we're missing though are some key items where we see cash go in or out the door that are going to show up on this report, which is going to show us our true actual net change in cash. And so in our example, we had $100,000 of net income. A client comes to us and says, "Hey, why didn't my bank account go up by 100 grand? I had 100,000 in net income." Well, there's a couple things we got to do. One, on your P&L, and for simplicity, we're just going to say we had $10,000 of depreciation and amortization on the P&L. Well, that's actually expense that we take that there was no cash that went out the door. Depreciation and amortization are going to be common add backs we're going to see on the statement of cash flows. So that's actually going to be added back on that statement of cash flows report. So the statement of cash flows is going to start with our net income. That's the top line. And we're going to add back any items that were non-cash items from the P&L. So depreciation, amortization, those are actually going to get added back. So in our example, we had $100,000 of net income. We had $10,000 of depreciation amortization. That's actually going to get added back. So now we're up to 110,000 to the positive on profit. What we're missing, though, however, are key items that we typically see in a practice. Debt payments, distributions are two of the big ones. If we paid any cash for equipment, that doesn't show up on the P&L because we're going to capitalize those equipment purchases, put them into fixed assets, which are going to show up on the balance sheet. So on our statement of cash flows in this example, again, we've added back our amortization depreciation. Let's say in this month, we bought $10,000 of equipment in cash. We had $25,000 of principal payments and we had $50,000 of owner distribution. So none of those are going to show up on our P&L, but they are cash items out the door. So we had $10,000 of equipment. That now gets subtracted from our statement of cash flow. So we went from 100 to 110 back down to 100. We have $25,000 of principal that we paid down on our notes. So that 100 then turns into 75,000. And then we had owner distributions of $50,000 this month. So a total net change of $50,000. So profit and loss shows $100,000 net income. We see some cash changes on the statement of cash flows, add back amortization, depreciation, take out our debt payments, our equipment purchases, and owner draws. So now we're left with a $50,000 change in cash. So our bank account went up $50,000, even though we had $100,000 of profit. We get to the last financial statement that we're going to review each month. This is a balance sheet. I like looking at a balance sheet comparative to the prior period. So when we look at a month end, I like to include the current month end and the prior month end so I can see the changes that have occurred. So on the balance sheet, this is going to show us all of our assets, so our bank accounts, our fixed assets, items like that up in the asset section, our liabilities. So any liabilities, we have note payables, things like that in the liability section. And then our equity section, which is going to be owner contributions, owner draws, retained earnings. So when I'm looking at the balance sheet, I get to see very quickly from this month, I should see our cash go up $50,000 from the P&L and statement of cash flows that we just walked through in this example. I should see equipment go up by $10,000 because we purchased those new equipment items. So our equipment account should go up 10 grand. we should see amortization and depreciation, which is actually a contra asset. That's where we see some reduction in the value on the books of assets. Those will also increase by that 10 grand from the P&L. Our liabilities, so we should see a $25,000 reduction in our note payable balances. We had 25,000 of principal reduction that we saw on the statement of cash flows. And then our owner distributions account, we should see go up $50,000 in our example. We took out owner distribution. So to put a bow on this, guys, all three financial statements are very, very crucial. We want to be looking at all three of those. Hope to give you a good understanding of how to read each of those, why they're different and why they're important.